You just clicked on the video that might save your credit score before it's too late to do it painlessly. If you've ever checked your credit score and felt confused about why it dropped when you thought you were doing everything right, or if you've ever made a financial decision that seemed completely harmless in the moment and found out months later it quietly wrecked your credit, you are not alone, and this video is exactly where you need to be. Because here's what nobody warns you about. The mistakes that destroy credit scores the fastest are almost never the obvious ones. They're not, "I stopped paying my bills entirely." They're quiet. They're logical sounding. They're things that millions of financially responsible people do every single day thinking they're being smart, and the credit scoring system penalizes them for it anyway. Most people think your credit score goes down when you do something financially irresponsible, miss a payment, rack up debt, default on a loan, and yes, those things destroy your score. But the belief that responsible behavior automatically protects your score is where people get blindsided. Because there are moves that feel responsible, look responsible, and are being made with completely good intentions that the scoring algorithm treats as red flags anyway. Here's the contrarian truth. Your credit score doesn't measure how good you are with money. It measures how predictable you are to lenders. And predictability, in the language of FICO, has specific rules that have nothing to do with your intentions or your actual financial health. The people who protect their scores the best aren't the ones with the most financial discipline. They're the ones who understand the rules of the system they're being scored by. I've gone through every major credit mistake that causes score drops. The ones that show up repeatedly in credit counseling sessions, in personal finance forums, in conversations with people who can't figure out why their score won't recover. And what I found is that the most damaging mistakes fall into two categories. The ones people know are mistakes but underestimate the damage of, and the ones people genuinely don't know are mistakes at all. Today, we're covering both. Here's the plan. We start with the mistake that causes the single fastest and most dramatic score drop, and it happens to people with otherwise excellent credit more than anyone else. Then we cover the mistake that slowly bleeds your score over months without any single obvious cause. After that, the mistake people make specifically when they're trying to be financially responsible. Then the mistake hiding inside a decision most people consider completely routine. And we close with the mistake that compounds every other mistake on this list and makes recovery twice as hard. Let's start with the mistake that causes the fastest and most dramatic credit score drops. And that's missing a payment by 30 days or more. Not missing it entirely. Not defaulting. Just being 30 days late. 1 month, and the damage is catastrophic in a way that most people are genuinely not prepared for. Here's what actually happens when a payment becomes 30 days past due. Your lender reports it to the credit bureaus as a late payment. That single negative mark gets added to your payment history, which is 35% of your FICO score, the largest single factor. And the higher your score was before the late payment, the more dramatic the drop. Someone with a 780 score who misses one payment can see their score fall by 90 to 110 points in a single reporting cycle. Not over time. Immediately. In 1 month. And here's what makes it worse. That late payment stays on your credit report for 7 years. 7 years of every lender, landlord, and employer who pulls your report seeing that mark. The impact fades over time. A late payment from 5 years ago hurts you far less than one from last month. But it never fully disappears until the 7-year clock runs out. The brutal irony is that this mistake happens most often to people with otherwise excellent credit, because they're managing multiple accounts, multiple due dates, multiple auto pay setups, and one slips through. A card they rarely use, an account that changed its billing date, a payment that bounced because they switched bank accounts and forgot to update the auto pay. The fix is almost embarrassingly simple. Set up auto pay for at least the minimum payment on every single account you have. Not the full balance necessarily, though that's ideal, but at minimum, the minimum payment. That way, even in a month where you're traveling, dealing with a family emergency, or just completely distracted, the payment goes through and your perfect payment history stays intact. You can always pay more manually on top. But the auto pay is the insurance policy that makes sure you never accidentally hand the bureaus a 7-year mark over a bill you forgot. That's the most dramatic mistake. But the next one is more insidious because it doesn't happen in a moment. It creeps up on you slowly, month after month, until the damage is already done. The The mistake that slowly bleeds your score over months without a single obvious cause is letting your credit utilization creep up without realizing how it's being calculated. Most people have heard that you should keep your credit utilization below 30%. And they do. They look at their total credit limit, they look at their total balance, and as long as that ratio stays under 30%, they assume they're fine. But there are two things about utilization that most people get wrong, and both of them are costing scores silently every single month. The first misunderstanding is about when utilization is measured. Your utilization ratio isn't calculated on your payment due date. It's calculated on your statement closing date, the day your billing cycle ends and your statement is generated. Whatever balance is sitting on your account on that date is what gets reported to the bureaus. So you could pay your bill in full every month, never carry a balance, never pay $1 in interest, and still be showing high utilization if you're making large purchases late in your billing cycle right before the statement closes. Here's a real example. Your credit limit is $5,000. You charge $2,200 in the last 2 weeks of your billing cycle. Groceries, a car repair, a couple of bills. Your statement closes with a $2,200 balance. That's 44% utilization reported to the bureaus. Your score drops. 2 weeks later, you pay the full $2,200 before the due date. You owe nothing. You paid zero interest. But the damage to your score already happened because the snapshot was taken at the wrong moment. The second misunderstanding is that utilization is calculated both overall and per card. So even if your total utilization across all cards is 20%, perfectly fine. If one individual card is maxed out or near its limit, that card's utilization is still dragging your score down independently. The scoring model looks at your aggregate utilization and each card individually. The solution is to either pay down your balance before your statement closing date instead of waiting for the due date, or to spread your spending across multiple cards so no single card shows high utilization. And if your limits are low, call your issuers and request credit limit increases, which instantly reduces your utilization ratio on that card without changing your spending at all. People who fix this one misunderstanding often see their scores jump 20 to 40 points in a single cycle, without changing anything about their actual financial behavior. They were doing everything right. They just didn't know when the picture was being taken. Now here's the mistake that happens specifically when people are trying to be responsible. And it's one of the most common causes of unnecessary score drops I've ever seen. The mistake people make when they're trying to be financially responsible is closing credit cards they're no longer using. The logic feels completely sound. You have a credit card you don't use anymore. Maybe you got a better card. Maybe the reward structure changed. Maybe you just want to simplify your wallet. Keeping an account open that you're not using feels like clutter, so you call and close it. Responsible, right? Here's what actually happens to your score the moment that account closes. First, your total available credit drops. If that card had a $4,000 limit and your other cards total $6,000, your total available credit just went from $10,000 to $6,000. If you're carrying any balance at all on your other cards, your utilization ratio just jumped, possibly dramatically, with no change in your actual spending. Second, if that card was one of your older accounts, closing it affects your average account age, which is part of the length of credit history factor that makes up 15% of your score. The account doesn't disappear from your report immediately. Closed accounts in good standing stay visible for up to 10 years, but it stops contributing to your average age the moment it closes. And as your other accounts age, a missing old account means your average creeps down instead of up. Third, closing the card reduces your credit mix if it was your only card of that type. Fewer account types means a thinner, less diverse credit profile. The right move, almost always, is to keep the card open and use it for one small purchase every month or two to keep it active. A streaming subscription, a tank of gas, something that keeps the account from being flagged as inactive and voluntarily closed by the issuer. If there's an annual fee you're trying to avoid, call the issuer first and ask if they can downgrade you to a no annual fee version of the same card. Most major issuers will do this, and the account stays open with its full history intact. The only time closing a card makes sense is when keeping it open is causing you to spend beyond your means and accumulate debt you can't manage. In that case, the behavioral risk outweighs the score impact. But for a card that's simply sitting unused, keep it open. Let it age. Let it keep your utilization low. It's doing important work even when you're not touching it. But here's where it gets interesting, because the next mistake is hiding inside a decision most people consider completely routine, and it catches people completely off guard. The mistake hiding inside a completely routine decision is applying for too much new credit in a short period of time. Every time you apply for a new credit card, a car loan, a personal loan, or most other credit products, the lender pulls your credit report. That pull is called a hard inquiry. And each hard inquiry temporarily drops your score by a small amount, typically 5 to 10 points, and stays on your report for 2 years, though its scoring impact fades significantly after about 12 months. 5 to 10 points sounds minor, and for a single application, it is. But here's where people get into trouble. They're shopping for a new credit card and they apply for 3 in 1 month, trying to find the best one that approves them. Or they're buying a car and they visit 4 dealerships who each pull their credit. Or they're going through a life transition, new apartment, new car, new credit, and 3 or 4 applications happen in the same 60-day window. 4 hard inquiries at 7 points each is a 28-point drop. On a 750 score, you're now at 722. On a 680, you're now at 652. And that decline happens right at the moment you're trying to qualify for new credit, which means your rates go up, your approval odds go down, and you've penalized yourself precisely when the stakes were highest. The smart approach is to be strategic and sequential rather than simultaneous. Research cards thoroughly before applying and apply for one at a time. If you're rate shopping for a mortgage or auto loan, where comparison shopping is genuinely necessary, do all your applications within a 14 to 45-day window, because the scoring models recognize rate shopping behavior for installment loans and count multiple inquiries in that window as a single inquiry. That protection doesn't extend to credit cards, so space those out. And before you apply for anything, check whether the issuer offers a pre-qualification tool that uses a soft inquiry instead of a hard one. Soft inquiries don't affect your score at all. Most major card issuers now offer pre-qualification checks that tell you your approval odds without touching your score. Use those first. Narrow down your best option, and then apply once with confidence. Now, here's the final mistake, and it's not just a mistake on its own, it's the mistake that makes every other mistake on this list take twice as long to recover from. The mistake that compounds every other mistake and makes recovery twice as hard is not monitoring your credit report and catching problems before they compound. Most people check their credit score occasionally when they're curious or when they're about to apply for something. But there's a critical difference between checking your score and monitoring your credit report. Your score is a number. Your report is the story behind the number, and the story is where the problems hide, sometimes for months or years before anyone notices. According to the Federal Trade Commission, 1 in 5 Americans has an error on their credit report, an account that isn't theirs, a late payment that was actually paid on time, a collection account that was settled but never updated, a debt that's past the 7-year reporting limit but still sitting there artificially lowering the score. These errors are not rare edge cases. They are statistically normal, and every month they sit undetected, they're doing damage. Beyond errors, there's fraud. Credit card accounts opened in your name without your knowledge. Hard inquiries from lenders you've never contacted. Addresses on your report from cities you've never lived in. Identity theft often starts quietly. A small account here, a single inquiry there, and by the time someone notices, the damage is extensive and the recovery process is long. The solution is to pull your full credit report from all 3 bureaus, Equifax, Experian, and TransUnion, at least once every 4 months. AnnualCreditReport.com is the only official free source for all 3. Stagger them. Pull Equifax in January, Experian in May, TransUnion in September. And you have continuous coverage across the whole year for free. When you find an error, dispute it in writing directly with the bureau that's reporting it. Send it certified mail with documentation. The bureau has 30 days to investigate and must remove any item they cannot verify. One successful dispute can restore points that took months to lose, and it costs you nothing but the time to do it. And consider placing a credit freeze if you're not actively applying for new credit. A freeze is free, it can be lifted in minutes when you need to apply for something, and it makes it virtually impossible for someone to open new accounts in your name without your knowledge. It's the single most effective identity theft prevention tool available to consumers, and most people have never used it. If this video helped you, hit the like button. It genuinely helps this channel reach more people, and it takes you 1 second. Subscribe if you want the follow-up video I'm dropping next week. It covers the exact step-by-step redemption strategy to get the most value out of every point you've already earned. You've done the hard part. That video will show you how to cash it all in. I'll see you there.